You're about to spend 60 G's on a dorm your kid is going to hate when you could have bought a house and had the roommates pay for the mortgage. I've been in mortgages for about 23 years and I've seen just about everything. And today I want to tackle a problem that's hitting a lot of families, the rising cost of student housing. If your kids are in college or heading there, you've probably felt this. Did you know the average room and board of a public university runs about $13,000 a year, which is actually more than most in-state tuitions on average? It's climbing every year, often outpacing inflation. For many families, that dorm bill or off-campus rent check is a huge burden, and it's money that doesn't come back to you. But what if you could turn those housing dollars into an investment instead of an expense? What if paying for your kids' housing could actually build equity for your family? That's what we're talking about here today. I want to introduce you to an approach some families are using. Fannie Mae's Family Opportunity Mortgage. It's a tool that can help you or your clients, if you're an agent out there, buy a home for a family member, like a college student or an aging parent, with the same advantages as a primary residence loan, even though you won't live there. This is a game changer. So let's break down some of the details. Let's talk about some of the successes and figure out how you can take advantage of it and turn that expense into an investment. All right, in a nutshell, the Family Opportunity Mortgage, sometimes called the Family Assist Program, is a special conventional program that lets you purchase a home for a family member and get owner-occupied loan terms without personally occupying the home. Normally, to get the low down payments and best interest rates, lenders require a home to be your primary residence. If it's an investment property or a second home, the requirements get tougher. Usually 20 or 30% down, 10% of course on a second, and higher rates for rentals and even for seconds these days. Or the distance requirements for a second home kicks in, like a 50-mile plus distance away. Co-signing for a family member's loan is another route, but that typically means that the family member, say your child, has to be on the loan and title as an occupied owner, which isn't always feasible if they have little income or very little credit history. Family opportunity mortgages change that. It allows, for example, a parent to buy a home for their child, or vice versa, an adult child for a parent, and still qualify for the same terms they would get if they were buying their own house to live in. In other words, the loan is treated as an owner-occupied primary residence loan, even though the occupant will be your family member. This is huge. It means much lower down payments and lower interest rates than an investment property loan. In fact, you could put down as little as 5% instead of 20% or 25% and snag a competitive rate just like a primary home. Plus, Fannie Mae doesn't enforce a distance rule here. The home can be near your own residence if needed and still get those favorable terms. Now, to use this program, there are certainly some rules that we have to abide by. Fannie Mae essentially wants you to ensure that it's truly going to help a family member who needs assistance, not just a loophole for buying a vacation home or a rental home. The family member who will live in the home must legitimately be unable to qualify for the mortgage on their own. Usually that means they don't have sufficient income or are unable to work for whatever reason. Again, think of an elderly parent on a fixed income, a disabled adult child, or a student with zero income and zero credit. Lenders will actually require documentation like pay stubs or even Social Security or disability award letters to prove your loved ones can't afford the loan by themselves. And as the purchaser, you have to qualify for the loan with your own income and credit, taking on the payment in addition to any mortgage you already have, and then of course any other credit card or car loans or any other debt that's going to show up on your credit card. So you'll need to show you can handle it. Typically, they'll look at a reasonable debt-to-income ratio of around 45% or less, of course, and a credit score of at least 620. The family member, your child or parent, who you're buying the home for must intend to live in the home as their primary residence, generally for at least 1 year. This isn't a buy and lease investment deal. You can't turn around and rent this place out to vacationers or unrelated tenants right away. The whole point is providing housing for that family member. For example, if your college-age son or daughter, he or she needs to actually live in the home while at school, and no, you as the buyer don't have to live there at all, that's the key feature. If it's your elderly mother, she'll occupy the home. Essentially, you aren't required to move in, but your family member is. There's some flexibility. The property can be a single family house, a condo, of course, if it meets the requirements of Fannie Mae, townhouse, etc., as long as it's a normal residential home and in livable conditions. To recap, let me list the key facts and requirements for a family opportunity mortgage. Low down payment, as little as 5% instead of a 10 or 20% for other non-owner deals. Primary residence interest rates. You get lower interest rates comparable to owner-occupied loans, not inflated rates of investment properties or second homes. Credit and income. Typically need at least a 620 score and to be able to show stable income that can cover the new mortgage plus your own housing costs. Usually a max of around 45% debt to income ratio is expected. This can absolutely be stretched a bit with some strong compensating factors. Occupant qualification. The family member cannot qualify on their own due to insufficient income or other limitations. You'll have to provide proof of that. They might be a college student, an elderly parent, or a disabled adult or child in most cases. Occupancy rule. The home must be the primary residence for the family member for at least 1 year. You, the buyer, will not live there. There are no occupancy requirements for you whatsoever, but you still get to finance it as if it's your primary residence. That's the program in a nutshell. Now, let's talk about how this actually plays in real life, because it's more than just numbers. Imagine this scenario. Your daughter is headed off to the state university and the campus housing prices are rising through the roof. I mean, this is pretty real. A dorm and a meal plan could be well over $12,000 a year, maybe more. And that's the money you'll never see again. Off-campus apartments aren't much better. High rent, maybe far from campus, and you have no control as a parent over the conditions or rent hikes. Now, suppose instead you find a modest 2-bedroom or 3-bedroom home near campus for around $200,000 or even $300,000. With the family opportunity mortgage, you could buy that condo, that single family, or that townhouse with 5% down. That's $10,000 or $15,000 depending upon the purchase price, and finance the rest. So with today's rates, the monthly mortgage payment, principal and interest, might be around $1,200 to $1,500. And when you add in taxes and HOA, you're going to be around $1,500, $1,700. Split that between you and perhaps a roommate or two, and your daughter can rent the second room, the third room, and suddenly your out-of-pocket expenses will be less than $700 a month. That's about what you would pay for housing anyway. Many dorms easily cost $1,000 per month when broken down, except now you're building equity. Instead of writing a check to dorms, you're writing a check to your own assets. Over 4 years of college, you've essentially converted that rent into an investment. Your daughter has a stable place to live. You don't have to worry about noisy dorm neighbors or surprise evictions because a lease ended. And maybe she learned some responsibility by helping manage that place on her own. After graduation, you have options. Sell the property, potentially making a profit in the market that it's appreciated over the last several years. Or you could keep it and rent it out, maybe to other students, for additional income. In some cases, families hold on to these condos or these single families for their younger siblings who will attend the same college the next couple years. Or they just keep them as a long-term investment. The point is, you haven't been flushing housing money down the drain. You've been building wealth. Now, that's one example of a student. Let me give you a different example, helping an aging parent. Say your dad can't afford the house anymore, and he lives far from you, and you want him to be closer because he needs some additional care, needs more attention. You look at an assisted living facility, and you nearly fall out of your chair when you see the actual cost. They may cost thousands of dollars per month. In many areas, a decent assisted living or nursing home can be incredibly expensive. Here's where a family opportunity mortgage could come in. You buy a small home or a condo for your dad to live nearby. Because of this program, you're putting 5% down and you're getting a low rate comparable to your primary residence, making the monthly payment affordable. In fact, the mortgage payment could be significantly less than what a nursing home or senior rental would charge. Your dad gets to live independently in a home you own, with family checking in, of course. And again, that money is going into an asset you own, not a facility. It's a win-win. Your parent gets a better living situation and your family gains a property that can grow in value. Now, you might be thinking, couldn't I just co-sign a normal loan with my kid or buy an investment property outright? So what's so special? Well, it's a great question. So let's compare a couple different things. Co-signing or co-borrowing on a standard loan, this is sometimes called a kiddie condo. This strategy is basically your child or other family member would be on the mortgage as an occupant. You would be considered a non-occupying co-borrower to help them qualify. This can absolutely work. Since the child will live there, lenders consider it a primary residence for them, and you can often get away with a low down payment as well, as low as 5% on a conventional or even 3.5% on an FHA loan. The upside is the rates and terms are good. Owner-occupied terms, similar to the family opportunity mortgage in that sense. And it doesn't require a special program per se. But there are downsides. Your family member has to be part of the loan application. If we're talking about an 18-year-old with no credit income, that can absolutely complicate underwriting to some degree. You might need to add them and then basically qualify on your own income anyway, or use an FHA loan, which allows non-occupying co-borrowers with potentially higher mortgage insurance costs. Also, any debt the student has, like maybe a car loan or future student loans, could count into the mix. And their credit score, if low or thin, may affect the rate. In short, co-signing is doable and is certainly often used, but it effectively makes your child a co-owner from the day one and ties you both your credit profiles into the deal. Some parents prefer not to entangle their kids' finances or risk their credit at such a young age. Another option is buying it as a pure investment property. This is a route you would have to take without programs like the Family Opportunity Mortgage if you didn't involve the child on the loan. It means telling the bank this is a rental or an investment home. As I mentioned earlier, that triggers much stricter requirements, typically at least 20% and sometimes often 25% for best pricing. Higher interest rates, maybe 1% or more above the comparable primary residence loan, and you'll need to qualify carrying the full mortgage payment plus your own. Now, lenders also might factor in potential rental income by using a rent schedule, but since your tenant is your own kid, you're likely not going to be charging them market rent. And if you try to call it a second home, usually meant for vacation homes, lenders usually require it to be a reasonable distance away and used by you for vacations. Housing your child full-time isn't really the intent. There's also usually a rule that a second home cannot be rented out regularly. So the investment second home route is not as favorable here. It costs you a lot more cash up front and ongoing. Without the family opportunity mortgages, families were stuck either doing this or bending the rules by co-signing in creative ways. The Family Opportunity Mortgage Program basically cuts through all that, giving you an affordable option and one without needing your family member to qualify or co-own the property themselves. In summary, the Family Opportunity Mortgage combines the best of both worlds. You get the low down payment and rate like it's your own home, and you keep things simple by having only the willing, able borrower, you, on the loan while your loved one gets the benefit of living there. No need to juggle an 18-year-old's lack of credit or pay investor-level costs. It's about making it easier and more cost-effective for families to take care of their own. It's a powerful tool for building wealth. I really want to highlight the bigger picture here. This is more than just a niche program. It's a strategy building long-term wealth while keeping families' needs in the forefront. Instead of pouring money into dorms or landlords' pockets, you're investing in real estate that your family controls. Over time, that can mean appreciation in the property's value, equity buildup as you pay down the mortgage, that amortization gain, and even potential rental income down the road. In fact, Fannie Mae's program explicitly notes that one of the benefits is the opportunity to build equity in a home for your loved ones. You're turning a major expense, housing, into an asset. It's also about the intangible benefits, stability and control. Your college kid isn't at the mercy of dorm rules or a flaky landlord. You're the landlord in a good way. Your parent can have a place to call their own home rather than feeling like a guest or being stuck in an institution. And for real estate professionals listening, this is a fantastic option to keep in mind for your clients. It can help offer solutions that people may not even realize are available. Now, not everyone knows that you can buy a home for someone else in your family and still get primary residence loan terms. Being the one to educate them could make a huge difference in your financial future and might earn you a lifelong client. Now, here's a few caveats to be completely transparent. Just because you can buy another home with only 5% down doesn't mean you necessarily should without carefully planning. you're taking on another mortgage. So make sure your own budget and emergency funds are solid. And remember that if you put less than 20% down, conventional loans will have PMI, private mortgage insurance, which is an added monthly cost until you gain enough equity. That said, with today's high rents and housing costs, the math often still works out in your favor, especially long term. Just run the numbers for your scenario. We can certainly help you with that. Work with a knowledgeable loan officer who has done family opportunity mortgage. Not all loan officers are familiar since it's somewhat of a specialty product. As a pro tip, you might not see a big banner advertising family opportunity mortgages at the bank. Some lenders use different names or handles to call it. So it's a case-by-case basis. So you may need to explain what you're looking for, but any lender selling Fannie Mae loans, which is the majority of everybody, should know the guidelines once you describe it. The bottom line, if you're facing an exorbitant college housing bill or struggling to find a living solution for your parent, don't overlook this option. The Family Opportunity Mortgage is about leveraging real estate to solve family challenges in a financially smart way. You can provide for your loved ones and set the foundation for future wealth. As I always tell my clients, real estate can be a powerful wealth building tool when used wisely. And here you're using it to benefit your family directly. So once again, I try to tell people this on a regular basis. This information was guaranteed.